Welcome to another In Conversation. I'm Alistair Francis, Director within the research team at Pitcher Partners Investment Services. Joining me today to delve deeper into property income as a source of investment return, I'm joined by Grant Berry, Director and Portfolio Manager of the SGH Property Income Fund. Welcome, Grant. Can I start by asking you, for investors that are comfortable with a property income stream, what are some of the offerings that are available to them in the market, and what are some of the issues they should be considering about?
Well, firstly, for investors looking for income out of property, you could invest in property in your own right. That is, you could go out and buy an asset such as a residential property. It might be a childcare centre, a service station and the like. Another way you could invest in property for income would be through a property syndicate. So typically that is a single asset vehicle that has gearing within the structure managed by someone else, so you don't have to worry about managing the asset. And that's got its advantages. The disadvantage there, again, would be liquidity. If you want your funds back, you have to wait for the asset to be sold to get your funds back out of that asset. The last one is listed property securities, either in your own right or through a managed fund. Now, they've got the advantage that they've got immediate liquidity. You can sell your asset or sell your investment in the securities or redeem in a managed fund, and typically you'll get your cash back in 2 days. So that's the advantage there. The thing about them, though, however, is they are volatile. They move around more because they're daily pricing. So, some investors, may find that a little bit harder to adjust with, but over a long period of time, you'll get a property-like return and a good source of income. What I would say is the asset quality is very high and they are well managed. So that's an advantage there. Unlike the first one with the direct property, you don't have control over the capital structure and you don't have control over what assets they might buy or sell. So that's something that you can consider as well. But the quality of the assets is very good and they're well managed.
So what is the fund's investable universe in order to generate this property income?
We're looking for property securities, listed property securities, typically REITs. So our real hunting ground is looking for those securities where the primary income is from rent, for income. That's what we're looking for. In terms of our fund, we must be at least 80% invested, so we can hold up to 20% cash. We must be diversified, so we must hold a minimum of 10 securities, and we can't hold more than 15% in any individual security. We can invest in developers and contractors, so that's another source of income, and we do have one developer in our fund at the moment. It tends to not be a very big part of the fund. We're limited to 15%. Currently we're about 3% in terms of the developers, and we can also invest in unlisted securities in terms of if they're coming up for an IPO, and we'll typically only do that if it's about immediate IPO. We do have an allocation to global REITs, however, we tend not to do that. What we're finding is our clients that want global REIT exposure tend to go to a more pure play global REIT offering that we have.
So what are the sectors that the fund is currently exposed to?
Well, firstly, quality retail. And retail is really interesting because people think of retail and they often put it in one bucket, but it takes many different forms. Firstly, service stations are actually classified as convenience retail. And you think about that, you go in there and buy a lot of your daily needs. Then you move up the spectrum to your larger convenience retail, which typically has a supermarket and a number of specialty shops. Then moving along, you have factory outlets, you have large format retail, and finally the top tier assets we're talking about, like the Chadstones and the Bondi Junctions. Now, retail has been performing very well. The consumer has been in great shape, underpinned by strong employment, and we're seeing really good conditions there. So that's a really good source of income. The next one would be office. Office is a bit more of a challenge sector at the moment. We've had work from home, obviously, as a feature flexible work, and that's been a bit of a headwind. But it's still a good source of income, certainly in the REIT sector, because they are trading at a discount and they're providing a good income yield. Moving along, residential is a source of income. And the way we get income out of residential is through the development activities. So stocks such as Stockland, which is one of our largest holdings, they've been around for 60 years. They are a land developer, so the income is coming through as they sell the lots. But we're also seeing income in residential in a number of new forms. One of them is land lease communities. So land lease communities is whereby our investments own the land. They build homes for the resident. The resident actually owns the homes. The resident then pays rent for the right to occupy our land. So that's providing us a source of income, as well as the income from selling them the actual home. So that's a good one, and it's a really growing sector with tailwinds. Affordable housing is another one. We have exposure to affordable housing through one of our entities. It's big in Australia. It's a huge area, but at the moment in the REIT sector, it's very niche, and I can see that that can be a growing sector going forward. And finally, build to rent. So that is like building more a high-rise apartment offering, but very well managed by an REIT where they have concierge, they've got all the amenity, all the facilities, and the resident has confidence of having long tenure and not dealing with a smaller private landlord. So that's a growing sector. It's performed very well overseas, and we're seeing that develop in Australia. Other source of income, of course, industrial. That's a good source of income. It's got growing income at the moment because there's strong rental conditions, typically lower yield. And finally, we move on to the last subsector, which is what we call specialised. And that's areas like social infrastructure, childcare, storage is another one, healthcare is another one again. And what we find with the specialised areas is they tend to be less economically sensitive. Reason being, if you think of childcare, we always needed it. It was, something that was very much needed in the pandemic, for example. And, they typically, these assets have long leases with built-in rentals increase structures, or they're inflation linked and the tenant pays for all the operating outgoings. So they are very good, durable assets to own over a long time. So there's some of the areas that we look for income.
So is the rental income stream growing?
Yes, it is. The rental income stream is growing across all the property sectors we're finding at the top line. With the exception of office, it's more challenging, and I'll get to that in a minute. So if you think about a typical building, they have leases, and the leases have structured rental increases, or they may have inflation-linked increases, and that's giving you a source of income growth. Of course, the leases expire, so then the issue is how do they perform when they have expiries? So retail, I mentioned that before, what we're finding is positive releasing spreads when the tenant's leases expire. And we're seeing that generally across the property sector. Office is the more challenging one. If you think about, say, a Westfield Centre, I'll just narrow in on that one for a moment because they're very big and they're very evident. Their leases typically have CPI, so inflation, plus 2% structured into their leases. So at the moment with inflation very high, their leases have actually been getting 8% rental growth, would you believe? And when their leases expire, in the order of 2.6% rental growth. I did mention office before. What we're finding in office is their rental structures are typically in that 3 to 4% band, so they are growing, but when their leases expire, the landlord has to offer a sizable incentive for the tenant to renew or to find a new tenant in. So it's a bit more of a drag there. But across the board for property, we're getting good income growth at the top line.
You mentioned CapEx spend, so there's much activity in that space in order to grow rents?
Well, firstly, there's two components of CapEx spend. There is development CapEx spend and then there is maintenance CapEx spend. So I might just touch on the first, development CapEx spend. So development CapEx, if you think about it in the context of, say, an office building, it could be building an office building. It was previously an old building, you knocked it down, you build a new building, and you're getting a source of rent from that. So that's development CapEx. It might be a shopping centre and you're expanding that shopping centre, development CapEx. I touched on Stockland before. Of course, there's development CapEx with doing residential sales and also with apartments and so on. So that's at CapEx. But what we're finding at the moment is development CapEx is quite low at the moment. It's quite quiet, other than in residential and industrial. It's quiet in office and retail because the cost of debt is quite high at the moment. So that's making it a bit more of a challenge. And in the case of office, capitalisation rates or income yield requirements have also moved up. So that's making it more challenging. So that's holding back development CapEx. In terms of maintenance CapEx, you've got to keep your building relevant so that you can attract tenants, so you can grow your rents over time. You don't want to neglect your buildings because your competitors will be improving their buildings and keeping them relevant and they'll capture it. So what we're finding is generally for an office building, you'll spend around 1 to 1.5% of the building's value each year in terms of CapEx and incentives to keep that building relevant and keep tenants moving along. Retail is less than that. It can be as low as 30 to 40 basis points or 0.3 to 0.4%, up to as high as 1%. So it is lower there. And industrial is somewhere in that range as well, quite lower. And then finally we move into the specialised sectors. They're interesting because what we find with a number of the specialised sectors is they have what we call triple net leases. And that means that the tenant bears a lot of the costs, So you're getting very limited maintenance capex and incentives. They're effectively picking up that and not paying incentives. So that's good in that context as well.
Given the higher than normal inflationary pressures along with higher interest rates, how do REITs manage that risk?
Well, first we might talk about income. So we just mentioned rental income and how that's grown over time. So that is one source of managing risk. If your income is growing, and I talked about the Westfield centres where their rents have been growing in the order of 8%, that helps mitigate the risk of rising interest rates. Of course, then you move to the balance sheet. The REITs typically have gearing. Gearing is generally around the 30% in the sector, in some cases higher, in some cases a bit lower. That is a lot lower than what it was in the GFC. So in the GFC, we had gearing 40% plus. And then back then we had higher interest rates as well and very high credit spreads. So the gearing is lower and the balance sheets are actually in pretty good shape. And that was well tested through COVID, where if you think about it, some of the assets couldn't even collect all their rents, such as the shopping centre. So that was well tested. The next thing is how you manage your interest rate risk exposure. So what the REITs typically do is they have part of it is floating rate debt, which is exposed to rising interest rates, and the other part is hedged. So typically the REIT sector is hedged around 70% at the moment, and then those hedges reduce down over time, and then your income is growing over time to help mitigate that risk. Also, you can manage your interest rate expiry and your debt by diversifying your debt, your tenure of your debt, and so on. So there are ways to do that. Finally, if your gearing is more elevated or you're concerned about interest rate rises down the track, you can actually sell assets. And we're finding that a number of REITs are selling assets at the moment. What they are doing is they're selling their lower quality assets and they're selling that into the market. And interestingly, these REITs are trading at a discount much deeper than the asset values of where they're selling them. And that's a way that they can reduce their debt, and it's not really impacting their earnings because of the cost of that debt. So they're effectively curating their portfolio, keeping the best quality assets and using the opportunity to sell the lower quality assets. Look, one more thing that I would like to add, and it's relevant for office, but it's very relevant for all property, and that is population growth in Australia. Population growth is very strong in Australia. It's forecast to be significantly stronger from any of the developed countries that we're aware of, that we look at. And it continues to surprise on the upside. In fact, in the paper today, I see that 500,000 people are coming into Australia. So it's very strong. That's a very healthy dynamic for all property longer term. Whether it's residential, people needing to rent a house, buy and build a house, industrial, expanding industrial facilities to accommodate for logistics, retail, of course, more people through our shopping centres, and finally, with office, we're going to have more workers in this country longer term. So that's a very good dynamic for property. And then balancing that off, as I mentioned earlier, high interest rates, more limited construction is holding back the supply side. We want to see, of course, more supply in the residential, but in terms of if you own an existing in situ asset, such as a shopping centre, and there's less developed, or an office building, having less supply and more demand sets you up very well for the long term.
Thank you for joining us today. I really appreciate you sharing your thoughts with us.
Thank you very much, Alistair. It's been great to be here. Thank you.
If you'd like to explore more, please reach out to your Pitcher Partners investment advisor, or look at our website, our YouTube channel, or LinkedIn.